Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance. And let me tell you, this latest filing from Horizon Space Acquisition Corp is a real doozy. It's like trying to find a needle in a haystack, but with more spreadsheets. So what's the story here? Horizon Space Acquisition Corp is a blank check company, meaning it was formed to buy another company. They had until December 2025 to find a target, and we're looking at their financial report for the quarter ending June 30, 2025. Let's dive straight into the numbers because that's what you're here for. On the balance sheet, a few things jump out. First, their cash position is pretty small, only about $13,259 as of June 30, 2025. Now, most of their money is tied up in a trust account, which is a good thing because that's meant to protect shareholder money until they find a business to buy. That trust account holds over $22 million. Looking at liabilities, they have about $5.5 million in total liabilities. A big chunk of that is about $3 million in various loans, including working capital loans from related parties and promissory notes. Now let's talk about shareholders' equity. It's actually a deficit, meaning they owe more than they own on paper, around negative $5.4 million. This is typical for a company that hasn't started operations yet and is primarily funded by loans and investors. Moving to the statements of operations, we see they had a net income for the 6 months ending June 30, 2025 of about $147,000. This income primarily comes from interest and dividends earned on that trust account money, which was over $454,000. But remember, they also had operating costs. During this same 6-month period, their formation and operating costs were about $307,000. So while they earned money from their investments, their actual operating expenses were higher than that income, resulting in a net loss from operations. This led to a small net profit for the period, but it's important to remember this isn't from running a business yet, it's from the money they have saved. The cash flow statement confirms that their operating activities used up cash about $354,000 for the first 6 months of 2025. They didn't have much activity in investing or financing during this time, mainly reflecting money moving in and out for extension fees and loans. It's clear from these statements that Horizon Space Acquisition Corp is burning through cash as expected for a company in its position, relying on loans and the trust account to keep going. Now let's touch on something serious. Going concern. They explicitly state that their cash and working capital are not enough to finish their plans to buy a business in the next year. This means there's a real question about whether they can survive as a company without a successful business combination. They mentioned that if they don't find a business to merge with by a certain deadline, they'll have to start closing down operations. This is a pretty big red flag. It highlights the high-risk nature of these SPACs, where the clock is always ticking to find a deal before they run out of money or their extension options expire. Looking at shareholder equity, we see the details about their shares. They have ordinary shares and preference shares. Most importantly, they mentioned that as of June 30, 2025, they had about 2.3 million ordinary shares issued and outstanding, but nearly 1.9 million of these are subject to redemption. This redemption feature means that these shares can be bought back by the company, usually in connection with a business combination, or if the company liquidates. It adds another layer of complexity to understanding their true equity structure. And what happened after June 30th? Well, on July 25, 2025, they received another $120,000 as an extension fee. This is a recurring theme showing they are pushing their deadlines and relying on external funding, primarily from Squell Enlivened Hong Kong Technology Limited for these extensions. This constant need for extensions and loans to stay alive is a clear sign of the pressure they are under to finalize a business combination. The management discussion section really hammers home the going concern issue. They admit they have no revenue, rely on trust account interest and loans, and expect to keep spending on finding a target. They even say they may need more financing to avoid running out of money. This is the critical point. If they don't find a business to merge with by their deadline, the company will likely dissolve. The report doesn't sugarcoat it, stating there's substantial doubt about their ability to continue as a going concern. So what's my take on Horizon Space Acquisition Corp? Their financial picture is really that of a company in transition, with most of its assets in a trust account awaiting a business combination. They're burning cash through operating expenses and relying on a very tight deadline and external loans to keep the lights on. The biggest risk, as they clearly state, is their ability to find and complete a business combination before their extension periods run out. If they don't, the company as we know it will likely cease to exist. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.